What if I told you that the financial crises that cripple nations, wipe out savings, and force governments to borrow endlessly weren't accidents? Hidden behind the veil of balance sheets and interest rates, a few powerful institutions were quietly orchestrating chaos to extract wealth from ordinary people. Today, we're diving into the shadowy world of central banking where crises are not mistakes. They're a tool. This is the story of how central banks manufacture crises to harvest public wealth and why. Almost nobody sees it coming. To understand how this system works, we need to step back in time. Central banking is not a modern invention. It's centuries old. Tracing back to institutions like the Bank of England in 1694, these banks were originally created to lend money to governments, but over time they became something far more powerful. Visuals, old banknotes, historical buildings, portraits of early bankers. Key figures like Nathan Meyer Rothschild in the 19th century understood a simple but devastating principle. Money itself could be used as a weapon by controlling the flow of credit, interest rates, and national debt. These early financiers could manipulate entire economies and quietly profit every time a crisis struck. Fast forward to the 20th century, central banks became the ultimate arbiters of economic life. The Federal Reserve in the United States, established in 1913, was tasked with stabilizing the economy, but as history would show, stability sometimes came at a hidden cost. How does a crisis get manufactured? It begins with credit money created out of thin air. Through a system called fractional reserve banking, banks can lend far more money than they actually hold in reserves. This sounds technical, but here's the effect. It inflates economies, encourages borrowing, and inflates asset prices, houses, stocks, even commodities. At first, everyone benefits. Businesses expand. Markets rise. Ordinary citizens feel wealthier. But this is a trap. The system is built on debt, and debt eventually demands repayment. The central banks hold the levers, raising or lowering interest rates, controlling money supply, and orchestrating bailouts when bubbles inevitably burst. These moves are presented as necessary interventions, but they often concentrate wealth in the hands of the few while leaving ordinary citizens to bear the fallout. Throughout history, there have been repeated cycles of boom and bust. Take the 1920s in the United States. The Federal Reserve expanded credit aggressively, fueling a stock market boom. Ordinary Americans invested heavily, believing in endless growth. Then came 1929, Black Tuesday, and the Great Depression. Millions lost their jobs, homes, and savings. Yet the banks, central authorities, and wealthy investors survived and even thrived. Government interventions funded by taxpayer money bailed out banks while ordinary citizens were left to face economic ruin. Visuals, stock market crash footage, people lining up for jobs, bank interiors. Fast forward to 2008. The housing bubble, inflated by easy credit and complex financial instruments, exploded. Once again, central banks stepped in, not to punish the architects of the crisis, but to stabilize the system. Often by transferring wealth from the public to private institutions, each crisis follows a similar pattern. Excess credit inflates a bubble. The bubble bursts. Governments step in with bailouts, and the cycle resets. But the real victims are always the citizens. Inflation erodes savings, pensions underperform, debt grows exponentially. Consider this. The global debt today exceeds $300 trillion. That's more than 3 times the entire world's annual economic output. Every crisis, every intervention, makes the rich richer and locks ordinary people into a cycle of borrowing, taxation, and dependency. And yet, most people believe these crises are unpredictable. In reality, they are designed, managed, and profited from. Governments and central banks promise reforms after each crisis, but these fixes rarely address the root problem. Policies like quantitative easiness is essentially printing money to buy government debts. This markets temporarily, but inflate asset prices, benefiting the wealthy. Look at today's economic landscape. Housing unaffordable. Wages stagnating. Student debt at record highs. Meanwhile, central banks hold interest rates near historic lows, inflating financial markets. The patterns are eerily familiar: 1929, 2008. And now history threatens to repeat itself. And the data is shocking. Since 2008, global central bank balance sheets have more than tripled. Yet median household wealth has barely moved. The system has perfected the art of transferring public wealth upward, again and again. So what can we learn from all this? Crises are not accidents. They are often engineered to protect and enrich powerful institutions. Debt is not just a tool for governments. It is a mechanism for extracting wealth from the public. Patterns repeat. Every major financial collapse has a familiar playbook: easy credit, asset bubbles, taxpayer-funded bailouts. The question isn't whether another crisis will happen, it's when. And when it does, remember, the system is designed to protect the few and profit from the many. Understanding this hidden mechanism is the first step to protecting yourself and demanding accountability. If you found this exploration eye-opening, make sure to subscribe and hit the notification bell. Share this video because the more people understand how the system works, the harder it becomes for these cycles of engineered crises to continue unnoticed. The wealth of nations is not inevitable. And the next time the headlines scream financial crisis, you'll know to look behind the curtain. Fade out with suspenseful music and visuals of global banks, currency notes, and economic charts.